Hi, everybody. Welcome for joining. We're doing our spring 2026 update on financial markets outlook. So, thank you, everybody who has signed up so far and has joined. We're letting some people filter in here as they get into Zoom and so forth. And Leah, maybe we can just go to the next slide and we can show that boring slide that we need to show. Um, Thank you. And so just I'll say hello to a few people and then introduce our speaker, who's Andrei from Fidelity. Maybe Erik will say a word or two, and then Andrei will take it away. We want to have a bunch of questions, so hopefully at the end we have a number of questions that we've got that people have sent in and that we've compiled. But so we'll pepper you, Andrei, and check your knowledge. But in the meantime, as well, please don't hesitate to put questions into the chat or into the Q&A. Here you got our team. So there's me. That's a more recent, lot more gray picture of me. You got Erik there, no gray yet. Nice to be young. And then you've got our team here that keeps us on our toes. You got Leah, Joan, and Kashfi. And that's what's going on there. So today we're really happy to be welcomed by Andrei Bruno. Andrei Bruno works with Fidelity Investments, and Fidelity Investments Canada is a really important partner for Erik and myself and the WWH Financial Group team. Most of our clients will own Fidelity Investments, and generally we've all had a very positive experience from there. There's a whole bunch of blah blah about what Andrei does here at Fidelity or there at Fidelity. He's the director of ETFs at Fidelity Investments Canada. So Andrei, and correct me if I'm wrong, but you're also involved in the Fidelity All-in-One portfolios, right?
Yep, that's
Yeah,
right.
yeah,
So,
which a bunch of clients hold. He's got an MBA from TMU. Like myself, he's a CFA charter holder. And unlike me, because I bailed after the first level, he finished his charter market technician. So well done, Andrei. And also, he's got a BSc in cell and molecular biology, which is unrelated to this, but it tells you that he can do math. So he's a smart guy, and we should listen to him. That's my intro. So, Erik, would you like to say a couple of words, and then we'll throw it to Andrei.
yeah, sounds great. Thank you, Per. Thank you, Andre. Thank you, Claudine, from our partners at Fidelity. And thank you to everybody for joining us today. So, really excited to work with our partners and have some intel as to what they're seeing under the hood and what's going on in the markets and try to make sense of what we've seen so far this year. So, thankful for everybody for joining us. And Andre, with that, I will pass the baton off to you and we can get rolling here today.
Amazing. Thank you, gentlemen. So let's check to see if my technology is working here. Hopefully, slides will come up and hopefully no black boxes. Okay, so folks, just a quick, I know we just did a little bit of background, but a little background for me is in a prior life, I worked as an FX trader. And then after that, I worked in derivative sales, focusing mostly on FX and interest rates. And all that to say is my kind of upbringing was taking a close look at the macro. So, especially in FX markets and obviously in fixed income markets, you're kind of working at that top macro level, figuring out kind of what's going on in the world, how is it going to affect rates, how is it going to affect. So that's kind of how I view the world. And frankly, once we get to kind of the bottom and the stock selection, there's a lot of people, especially at Fidelity, that are much smarter than me in terms of stock picking. So what I'm hoping to do today is kind of provide a 30,000-foot view, touch on every area of the market. We'll talk about stocks, we'll talk about bonds, we'll talk about commodities and FX a little bit, and what we're seeing in the world and trying to make sense of kind of all this volatility and all this craziness that we're currently seeing in markets right now. So first and foremost, also a fun disclaimer for everyone that they can read on their own time there. So the first thing I like to say is like, where are we in the cycle? Like, are we late stage? Are we early stage? Are we mid stage? We kind of use this to kind of frame our overall thinking when we take a look at more of the kind of the macro data. So kind of two places we like to focus on are obviously Canada and the US. So the US is kind of right there in that green green circle there in the late cycle. And now what I want to say about kind of where we are in the cycle, this is far from kind of a hard science. We have definitions for, what it means to be in late cycle, what it means to mid, what it means to be in a recession. So this is kind of our best guess of where we are. US late cycle, what typically happens late cycle, you see growth starting to slow a bit, which is in fact kind of what we're seeing a little bit in the US here. In terms of Canada, it's thought that we're a little bit further along, kind of, you can see us in that gray shaded circle there. So a bit on the right-hand side and half of it's on the left-hand side. So thinking we're kind of more in that kind of, I want to say recession. I don't want to use the R word, but we did have a negative quarter of GDP that we just printed. We haven't got our Q1 GDP numbers printed just yet, I don't believe. So it's possible we're already kind of sitting in that kind of recessionary area there. So think about that potential late cycle for the US, kind of further along the economic cycle here in Canada. Obviously, we've seen slowdown of growth, and we'll talk a little bit more about kind of those macro inputs a little bit later when we deep dive into kind of a little bit more of the macro. Now, let's think about GDP, like where are analysts thinking we're going here? So we've got select areas across the globe here. I mean, the general kind of theme across here is we're kind of entering this, or people think we're entering a bit of a slowdown in economic growth. So we can take it on the far left there. We've got Canada, the United States. As I mentioned, what the growth forecasts are pointing to is kind of lends credence to the last slide as well, is that Canada's kind of further along and maybe we're kind of ideally coming up and out. Obviously, we've got some macroeconomic headwinds here in Canada. Obviously, we're still kind of in a trade war with the United States, which typically doesn't lead to positive growth on our side. There's a lot of structural issues with the consumer as well. We've got a lot of mortgage renewals coming up this year in Canada. I think it's over 20% of mortgages are being renewed this year in Canada. So there's quite a good chance that a lot of folks, even though the Bank of Canada has been cutting over the last year or so, but we are on pause right now in terms of the Bank of Canada, which we'll talk a little bit more about later. Canadian consumers with that readjustment of their mortgage rate could see another hit to their overall wallet. And as we know, as a developed economy, if we think back to our Econ 101 and the GDP equation, consumption is kind of the largest portion of our GDP contributor here in Canada. So again, folks paying more for their mortgages typically doesn't portend to, good news on the consumption side there. Now, the other reason I do like to take a look at kind of where we are in the overall economic cycle is taking a look at factors. So factor investing. So, once again, we're digging back into kind of our Finance 101 textbooks here, thinking about Feynman, French, and their kind of seminal paper in I believe it was 60s or 70s. It's just in terms of looking at, what drives equity market returns over an investment cycle. So they identified these number of factors. And why do we care about this? Because depending on where we are in the cycle, different factors tend to work. Now, this is, again, this is what we've noticed in history. It doesn't mean that every single time we're in a late cycle, momentum and quality is going to outperform, but it does help us inform kind of what we can expect to see in certain areas of the market. Now, if we think about year to date, and we think about the US particularly, and we take a look at kind of the third column there, the late cycle where the US is, momentum has in fact continued to trend well this year and has been outperforming the S&P this year to date. It is the number one factor year to date. Quality, on the other hand, has not been a number one factor. So this kind of goes in the face of what we're seeing on this chart here. We've actually seen value outperforming, second best performing factor this year. And I think there's a couple things at play there. If we think about kind of those growthier tech names, obviously, if we take a look at the Mag 7, Mag 7 has underperformed the broader S&P 500 year to date. And I think if we think about that through a valuation context, the Mag 7 valuations were a lot richer relative to the rest of the S&P 500. In fact, if you strip out the Mag 7 and you just kind of look at the price to earnings ratio of the other 493 names, that P&E is trending a little bit closer to historical averages. So it's really those Mag 7s from a valuation perspective that was driving the overall valuation of the market a little bit higher here. One other thing I look at, I live in ETF land, so I often look at kind of ETF flows, but I generally like to use this as a proxy of, where is money going in Canada? Where are people putting money to work? And I think what's really interesting is a trend we saw last year and that's continued on to this year is on the equity side of the ledger. So if you'd rewound 3 years, 2 years, 5 years, going as far back as I can remember, all money was flowing into U.S. equities. That was like the number one flow category for equity ETFs here in Canada. What we saw last year is that flip right around tariff tantrum last year. So that would have been around March. We saw this flip. We saw more money flowing into international equities, and we've continued to see that this year. And I think there's a couple factors at play there. So number one, obviously the tariff tantrum kind of kicked it off. But I think number one is I think a lot of folks were overweight those growthier Mag 7 type names in their portfolio for the longest time and more generally exposed to US equities. So I think folks were thinking about diversification a little bit, but also from a valuation perspective. Again, if we look at ex-US and we look at valuations across the globe, those are trending, and they certainly valuations have shifted up a little bit over the last year and more recently as well, but they're a lot closer to kind of historical averages. So, I think from a valuation perspective, from folks having been just kind of overweight to U.S. equities and particularly those growthy names, as well as the fact is, I think since everyone has been talking US equity for the last several years, I think there are certainly a lot of rocks that can be overturned in international equity markets, and I think a lot of folks are starting to look there now. So we'll just want to dive into the macro a little bit more. So first and foremost, jobs in Canada. We have been seeing, a declining kind of a deteriorating employment situation here in Canada. Again, we're sitting at 6.5% as of the end of January for unemployment. So certainly nothing that's screaming, we're in a job recession, so to speak. But the job situation has deteriorated to some degree. This slide, and I'm going to show the U.S. Employment slide as well, doesn't matter as much for the Bank of Canada. Obviously, it's something that they look at, but the Bank of Canada is a single mandate bank. Their mandate is to maintain inflation within 1% to 3%. Now, to contrast that with the Fed, they have a strict 2% inflation target, but they also have the second mandate to maximize employment within the economy as well. So the employment figure matters a little bit more for the Fed relative to the Bank of Canada. And as we'll see here as well, U.S. unemployment still trending relatively low. Again, over 2024, 2025, we did see a slight uptick in unemployment. When you get a little bit more granular with the figures as well, when we're taking a look at firings and then net new jobs, there's nothing screaming again, that it's people are laying off necessarily. We have seen a little bit of that uptick, but generally not a ton of hiring, but not a ton of firing either. Obviously, with the current geopolitical risk as well, that's certainly not assisting in that matter there. CPI, which I think is a little bit more important. I do want to caveat this. So this chart goes to the end of January. If you take a look at the February CPI numbers, these have actually ticked up. So we do have kind of Canadian and US CPI kind of trending in the wrong direction. And obviously, most of that is attributable to the current geopolitical situation in Iran right now. Obviously, we all know what oil prices have done over the last couple of months, north of $100 a barrel, which we hadn't seen in quite some time. If you take a look at the last 3 to 5 years, oil was kind of trending in that kind of sweet spot Goldilocks zone of $50 to $80 US a barrel. So we've gone well through that, and we're seeing the downstream impacts kind of in, whether you're looking at the inflation break-evens, which essentially is, what does the market expect, the average inflation rate to be over a certain period of time? Those have certainly trended higher as a result of energy prices. So why does this matter? Why do we care? Well, it certainly puts kind of central banks into kind of a tough area here. So, if we think about Canada, we just had, Q4 of last year was negative GDP growth. Certainly a scenario where we might think about easing rates further into that type of scenario. But then on the other hand, we've got this inflation that's moving a little bit higher here. So, the big question is, it's putting the Bank of Canada between a rock and a hard place right now. So we got inflation trending in one direction and growth trending in the other direction. You know, are we going to end up in a stagflationary environment? You know, are we going to have the Bank of Canada who's forced to hike interest rates? You know, even though GDP is heading in one direction, even though we have a lot of Canadian consumers who are refinancing their mortgages this year. So it'll be really interesting to see how that plays out this year. But all that to say is it puts the Bank of Canada into a tough place. Now, the U.S. on the other hand, you know, they do have that hard 2% inflation target, which we are trending above right now, but they do also have that employment lever. So, you know, they can make an argument that, you know, employment is slowing, or, you know, there's factors in the employment market that justifies us cutting rates or keeping rates pat. So they do have a little bit of more flexibility just as a result of that dual mandate that they have. Now, just want to jump into some specifics on equities here a bit. So we do have returns in front of us. We do have some fixed income on the far right there as well. But we'll focus on kind of, you know, the left side of the table here that shows, you know, various equity markets across the globe. So all this to say, you know, continuation of last year, where last year was the first year in quite some time where U.S. equity markets weren't top dog with regards to from a return perspective. So we're seeing a continuation of that. International equity markets continue to outperform. Canadian equity markets continue to outperform, and EM is continuing to outperform here. So EM is getting a little bit of a benefit of a weakening of the U.S. dollar here. Obviously, Canadian equity markets are greatly benefiting from a run up in energy prices and just generally an inflation trade. So, you know, as commodities continue to march higher, it continues to help the S&P or the TSX, I should say. And, you know, as we know, we have a very concentrated equity market. And what's interesting is you often will see a divergence between what's happening in the Canadian stock market versus what's happening kind of in the Canadian economy, more broadly speaking. And as I mentioned, a large reason for that is how concentrated our equity market is. Now, what's been winning this year in terms of market returns, and we're taking a look at the S&P 500 here. It, as I mentioned, hasn't been the Mag 7. If you look on the far right there, information technology is the second worst performing sector in the S&P 500 this year. And unsurprisingly, you're kind of getting those, you know, those commodity plays that are doing well. So energies, materials, consumer staples, which is something more of a defensive sector, and utilities there. So the returns so far are suggesting folks are getting defensive. Folks are pulling a little bit back from that Mag 7 trade. You know, one thing I do want to talk about is AI a little bit. Obviously, we've been talking about that for the last couple of years. And the question is the AI trade here? Is it dead? What's going on in the AI space? Now, if we take a step back and we think of longer term trends, and I'm going to give you kind of my opinion on it. Like, I do think AI is going to be pivotal. It's going to be similar to when the internet came online. I think it's going to change fundamentally how everyone does business across kind of everywhere within the economy, not just the Mag 7s. I think where we are right now, and the way I like to think about AI, there's the software component, there's the hardware component, and then there's kind of the bricks and mortars component. And the bricks and mortars component being like, how does this affect the other 493 names in the S&P 500? How does, you know, a Ford Motor Company implement AI to streamline efficiencies across their business, as an example? So in terms of a longer term trend, I think there's a lot of opportunities with those other 493 names. And I think we're kind of getting into a point right now where we've got access to all these large language models. And I think internally, I can speak anecdotally for Fidelity, is included in here. A lot of companies are figuring out, like, how do we use these tools? How do we make our processes more efficient? How can we drive efficiency and subsequently drive margins? So I think that's going to be really exciting over the next 5-10 years to see how that all plays out. The other thing I would note about AI is, you know, even though those names are down since kind of the Iran crisis has kicked off, a lot of that is not so tethered to that situation. Like if we think about the spending associated with that, or the downstream revenues associated with that, you know, while it is reacting to these geopolitical events, you know, they aren't necessarily directly tied to those events. Obviously, you make an argument for energy. Obviously, a lot of these data centers require energy, so there is an increased cost input there. But generally speaking, and we had Mark Schmel speak recently, who runs our Global Innovators Fund, and his kind of stock and trade is obviously these growthier names. He's still quite fundamentally bullish on the space over kind of the medium and long term. So just wanted to make a quick note on AI, since it's been kind of front and center for the last couple of years. Now, as I mentioned earlier, we won't dwell on this too much, but the Mag 7, as I mentioned earlier, has pulled back response to this. So, valuations are coming in a little bit on the Mag 7 names, but they're still, again, the valuations on the Mag 7 are still quite elevated relative to the rest of the S&P 500 there. I alluded to this a little bit earlier as well. So on the top there, you've got the S&P and the TSX and their price to earnings in terms of, and then you've also got their kind of averages over the last long time periods there. So as I mentioned, S&P is kind of trending well above kind of historical averages there, driven primarily by those Mag 7s. Obviously, Canada, if we rewind to last year, was trading a little bit closer to kind of historical averages, but we have seen an uptick given the run up in Canadian equity markets over last year and to start off this year. Similar story in terms of MSCI EAFE, so that's Europe and Far East, developed markets and emerging markets. So, they had been trading kind of sideways from a valuation perspective for quite some time, but given that we've seen increased flows into the space and increased outperformance in those markets, we are seeing valuations creep up a little bit there as well. Now, we'll talk about rates and credit. So depending on who you ask, a lot of people don't like to hear about this, but given my background, I'd be remiss not to touch on kind of rates and credit. So a good place to start is kind of yield curve. So what you're looking at is yield curve back in February in the blue line there for Canada and the US, and kind of where we were, back in November of 2025. So, broadly speaking here, since last year, rates have moved a bit lower, but I want to talk more on a year-to-date basis. So we have been seeing kind of longer-term yields push higher, and that has been fundamentally a result of increased inflation expectations. So just as a quick, kind of fixed income 101, the short end of the yield curve is typically dictated by monetary policy. So, what is the Fed going to do? What is the Bank of Canada do? As we get further out on the curve, it's dictated by long-term growth expectations and long-term inflation expectations. So what we've seen kind of early on this year is we've seen kind of the curve steepen. So we've seen long end rates push a little bit higher, but we haven't seen short-term rate expectations. We're going to cover that in a moment of kind of what the market's pricing in terms of central bank activity. So if you're thinking about kind of your fixed income portfolio, there is some risks that we get longer than anticipated inflation here. We don't get a resolution to the Iran situation anytime soon, and inflation expectations continue to creep higher. As a result, you would expect in that scenario for longer term rates to continue to trend higher and higher and higher. So in terms of thinking about your fixed income portfolio and where you want to position your risk, that's certainly an input that you want to consider. Now, I will also say kind of the belly of the curve. So when I say belly, I say 2 years out to 7 years. We did see that part of the curve react quite a bit to the inflation, the prospect of higher inflation for a little bit longer. So, in terms of kind of risk reward area, there seems to be a lot more reward potentially in the belly of the curve. Since it overreacted and moved quite high, there is a potential that, if we do get a resolution and inflation expectations do come off, that we see kind of the rates in the belly of the curve head a little bit lower. So rates going lower, prices going up, good for your fixed income portfolio if you're positioned there. Now, this is a pretty busy slide. We're just looking at credit spreads. Again, credit spreads is just, what's the additional yield that a bond requires above and beyond the treasury rate. So think of a credit risk-free bond. So think of your investment grade bonds, your high yield bonds. Now, we won't go into all of this now, but I do want to draw your attention to kind of that row at the bottom there that says spread rank. So the lower you are to one, or the closer you are to the one, the tighter the credit spread is relative to historical averages. So all that to say is credit spreads are pretty tight right now, and for good reason. If we take a look at default rates, if we take a look at distressed, debt levels, they're relatively low right now. The other thing we like to look at is do we have a lot of bonds that are maturing this year, and a lot of corporations have to refi. There isn't a very large debt wall this year. We don't see a lot of corporations having to roll over their debt. So in terms of like thinking about, are there any cracks in the credit market right now? We don't see that. Obviously, we could talk about private credit, which obviously we are seeing some cracks there, but I would say a lot of the cracks with regards to the private credit markets are coming from a liquidity perspective. A lot of people trying to head for the exits in a short period of time. But when we take a look at the underpinning assets, even there on the private credit side, we aren't seeing a lot of distressed debt over there as well. Again, all that to say is, obviously we all think back to 2008 and think about the credit crisis. This is an area I like to look at to see, is there something coming down the pipe that maybe equity markets aren't thinking about? And we're not seeing that right now. Now to pivot over to central banks. So big question is, what's the Fed going to do this year? What's the BOC going to do this year? So when we take a look at the Fed, 15% chance of one cut that's been priced in for 2026. So market is not pricing in the Fed to do a whole lot of anything. And I think we've seen this shift quite a bit. If you would have rewound and taken a look at this about 2-3 months ago, or even late 2025, markets were pricing in a couple more cuts from the US. So we've seen a big shift there. In Canada, the market is not even pricing in the possibility of cuts. In fact, it's pricing in the possibility of 1 to 2 hikes in 2026. So again, I think if the Bank of Canada is forced to hike rates because inflation starts to trend well above their 1 to 3% band, I think that's going to lead to certainly a negative hit on consumption, both from the fact that folks obviously do have quite a bit of floating rate debt, whether it's on the mortgage side or line of credit side, but also overlaying those notes I made earlier about a lot of folks renewing their mortgages this year. So that wouldn't be a great scenario for Canada, having to cut in the face of heightened inflation, particularly going into a slower growth environment and overlaying the mortgage renewals here in Canada. Now, just quickly talk about FX and commodities here. We have gone over this. Obviously the big story this year is energy prices. As I mentioned, they're even higher when I took a snapshot of this, which was back in February. So even higher now, approaching $100 a barrel. And the energy story is really just predicated on how long is this, is the Iran crisis going to last for? I think you can expect higher energy prices as long as the Strait of Hormuz remains closed. And your guess is probably as good as mine as when that'll be resolved. It seems every other day we get positive news, and then the next day we get negative news that the strait is no longer going to remain open there. So again, we'll continue to see commodity prices march a little bit higher here, which obviously is funneling down into inflation, which ultimately is funneling down into the central banks and what they can or cannot do this year. So again, your main risk here is inflation remains high. Central banks are forced to either stay pat or raise rates, which again is going to have the most implications for our underlying portfolios. FX, just a quick note, broadly what we're seeing against developed currencies is that US dollar weakness kind of across the board there. Even against the Canadian dollar more recently, the US dollar has been weakening to some degree. Where this factors in for our overall consideration is, certainly there's certain products out there that are currency neutral, certain products that aren't. So obviously a consideration for how we're positioning our portfolio and our exposures to currencies. The one thing I will say about currencies is the trends in currencies take a long time to develop. We typically see, we try to think we can time currencies intraday, time currencies intramonth. It's a very, very tough thing to do. My only advice with regards to currency is try to take a longer term view. You typically see trends play out over 2, 3, 4, 5 year time periods where you see whether it's a secular bull market in US dollars versus CAD or a secular bear market of US dollar versus CAD. It's very tough to time FX markets and make kind of intraday calls. So generally speaking, when you're thinking about FX and thinking about how you want to position yourself relative to some of these foreign currencies, I think the great way to play it is take a longer term view. Now, just to kind of some final thoughts to kind of summarize everything here. Markets are very choppy right now. And what I would say is there's kind of no clear direction on where to put your money to work exactly. Like, anecdotally, I've got a lot of friends who are like, oh, everything's crazy right now. Where should I put my money exactly? And it's right now, there's, given the overhanging geopolitical risks, it's tough to say where is the winning pocket for sure. But the one thing I would say as well is it's a good time certainly to take a look at our portfolios, find out where are our risks. If you are still remain overweight to US markets and you want to look at a little bit of diversification, obviously ex-US markets, whether that's developed international, can make some sense for your portfolio. Because ultimately, if we think about it, not that this is my base case, but if we have a scenario where markets are continue to trend lower and lower and lower, the U.S. market is more richly priced relative to some other areas, other geographies there. So from a risk perspective, certainly some more risks that if we do get at larger and larger market corrections, that the U.S. is potentially exposed to more of the downside there. And as I had mentioned multiple times, inflation continues to be kind of a main risk that we're looking at. The big question is how long is it going to be here for? Are central banks going to try to kind of talk it away and bring back the transitory kind of verbiage they did many years back when they were hesitant to hike interest rates in the face of high inflation. So that's certainly a big bogey for this year. And as I mentioned, depending on what happens there, depending on how quickly the situation in the Middle East resolves itself, we could be looking at kind of sustained inflation for the rest of 2026. So that kind of wraps everything up. Well, it can open up for some questions if there are any.
Thanks, Andrei. So we've got a few questions here. I'll pitch in with one, and then I think Erik will probably jump in with a few questions as well when he's ready. So the first one is, there's so much news coming out, right? And so you've got the whole situation in the Middle East and Iran. You've got, the U.S. is talking about private credit and how there's some issues there, and with some of the smaller U.S. banks. At the same time, you've got, a lot of political moves in Canada with people crossing the floor and by-elections today. Then you've got, a wholesale change in the leadership of Hungary, which seems like, why would we care about Hungary, but it actually really affects the EU. So there's so much noise and news out there. What should investors actually pay attention to, and what can they safely ignore?
Yeah, I think this is kind of comes to like the hardest part as financial advisors or people who work in asset management and wealth management. It's really difficult to disentangle kind of the everyday noise and what you want your portfolio to do over the long term. Now, personally, the reason we do portfolio construction, the reason we do asset allocation within our portfolios is to kind of smooth out this everyday noise. Now, I can obviously respect, if we're in like kind of a 2008 scenario where everything's crashing, going straight down to the right, I get it. When we think about this geopolitical situation, assuming it doesn't spiral into World War III, obviously that'd be worst case scenario. But, personally, I kind of take it as this kind of sucks for markets right now. No one's got any clarity on where things are going. But ultimately, when I think about even my retirement portfolio, is like I've got my asset allocation in there. I've got the managers I like under the hood. There's going to be some intraday noise on that, but I know over time my portfolio is constructed in such a way that when I look at it when it's time for retirement, it's going to have done what I expected it to do. Now I know everyone wants to time the market and say, I'm going to go to 100% cash right now because we're going down 20%. It's just very hard to do.
Yeah.
It's just, I don't know anyone who's been able to do it 100% of the time, been able to rotate into cash. All I can say is, if you have concerns with what's going on right now, take a look at your risks. What are there ways that I can remove some risk from my portfolio? Whether it's, maybe I've been overweight those Mag sevens. I want to take a little risk off the table. Maybe I want to put a little bit of value in my portfolio to kind of offset a little bit of that volatility. Maybe I want to rotate a little bit in international equity markets to dampen the volatility. There's certainly tweaks we can make around the edges to smooth out the ride during these very bumpy times. But ultimately, I think what's most important is to take a step back and say, what is this portfolio supposed to do over what time period? Am I still sticking to that plan? Are there tweaks I can make to this portfolio right now to smooth things out and assess my risk? I think that's prudent for sure. But again, the hardest thing in this industry is managing kind of emotions. Like, we all look at the news, we all
Yep.
see our portfolios down, and we all want to say, let's sell all this stuff and buy treasury bills. But all the data suggested over the time, like, timing markets is extremely hard to do. Sticking to your gun, sticking to your plan over the long term has been kind of the winning formula.
And I agree. And one of the most important thing of sticking to the plan is regular rebalancing of your portfolio. So it's a terrible analogy, but when I play blackjack, I always try to, and I'm usually up winning money. I try to take, and I don't play for a lot, but I always try to take chips off the table, right, and then just play with the house's money. And so we've seen that a lot in the past few years, particularly with funds like Fidelity's Global Innovators Fund, which of course has just done so phenomenally well, with having years where it's up so much. And then we meet with clients and they feel like we're always selling that fund. And they say, don't you like that fund anymore? I said, no, we do. We love this fund. It's a great fund. We love what Fidelity is doing there. And then there are other funds. But the issue is that, you're now overexposed to them because they've done so well relative to everybody else. And we want to rebalance and get back to your target, your model portfolio. And so that discipline, I find, has helped a lot of people, right? And that's what I've seen on kind of what your team and what the global asset allocation team at Fidelity has done a really great job of managing that. So thank you. And so when markets go through periods of uncertainty like this, people get nervous. Is that kind of the advice you would give to to clients that are, or to investors that are nervous, is to just stay the course and focus on your model portfolio, right?
Yeah, I think so, because ultimately, every investor is different, right? You've got the 30-year-old investor who's got a 30+ year investment horizon, and they may be grossly overweight equities because they've got that long time horizon. And you might take a look at your portfolio and say, oh geez, like I'm down a whole bunch. And you're like, yeah, but you're saving for retirement. Like,
Yeah.
don't look at your portfolio. This, like, people don't want to hear this, but like, I have friends and I'm like, they ask me, they're like, oh, like, how's your portfolio doing? I'm like, I have no idea. Like, it's my retirement portfolio. Like, I'll check in on 30 years. And I know that's very hard for people to do, is to kind of take the emotions out of it. But ultimately, like, your portfolio asset allocation should match kind of what your risk and what your reward should be. Like, if I'm 65 years old, I'm going into decumulation phase, like, my asset allocation should be taking care of me in there. I should have my income producing assets. I should have, relatively small allocation equity. Like, my portfolio might be down some degree, but ultimately it's like, you're still going to achieve your investment goals. But everyone gets tied up in what's happening in my portfolio today. It's down X, down X. It's like, are you still on that path? Like, are you still going to get to where you need to be in 10, 15 years? And the only way you do that is if you stay the course. Like, obviously prudent, making some tweaks around the edges for the given current environment. Of course, I agree with that. Have some satellite positions. But your core positioning should be dictated by your risk tolerance and your goals. And the way that all this math works out is if you stick to that plan. When you start deviating from that plan, that's where things start to go kind of haywire.
Okay. And then you had a chart there showing the various countries or world economies and where they are in the cycle. I saw a different one, Fidelity, that had the US a little bit earlier in the cycle today, that one of your colleagues shared. But in general, the US is a little ahead of Canada in the cycle. That may be because of the US just being a better performing economy than Canada in general, and better productivity, but that's been an issue since I was at the Bank of Canada in the 90s. So,
Yeah.
so it's not getting solved this week. Um, but if we see the U.S. and it's interesting to see the U.S. in a late cycle, because at the same time I see so much opportunity in the U.S. with a lot of the regulations having been lifted in the U.S. A lot of both financial, environmental, and other. We can argue about whether that's right or not, but that's what's happened.
Yep.
And also with just the productivity gains that I believe are coming from artificial intelligence in the US. And it's not just, like you said, when you gave that example of the car companies, it's not just, Google and Meta and, all the Amazon benefiting from AI. It's, everybody is looking at how to use AI better, right? So, I know my wife works in a private school and, they're looking at how do they use AI to make their lives easier, right? So, it's kind of in the day-to-day routine tasks that they do. So it's going to affect everybody, and I do believe it's the fourth industrial revolution. But on that note, if you see the U.S. as kind of in mid to late cycle, what do you think about U.S. equities? Do you think the flows are right to flow out of U.S. equities and international in Canada, or do you think we stay the course in the U.S.?
I
We
mean,
stay neutral.
I kind of I kind of share your sentiment there. Like
Yeah,
I wouldn't personally, I wouldn't be going underweight US equity. I mean, you can try to make some
yeah,
valuation arguments, but like all those things you highlighted, like they are very much driving the AI bus. All those kind of regulations you mentioned as well. So, I'm glad you brought up but someone else was showing you something that may have pushed them a little bit further back. So, some of the debates, this was earlier on in the year, pre-Iran, mind you. Some of the debates are, do we need, like, is the US going to pop back into kind of mid-cycle?
yeah,
Are we going to get, and a lot of the things you mentioned in terms of a lot of the regulations going through, a lot of the productivity gains going through is like, are we just going to push them back into the mid-cycle? I very well think that that could happen. Because I mean, you're going to, like you mentioned, you've got all these companies implementing AI. You have to assume on aggregate that is going to trickle down to margin expansion at some point. I mean, we are going to get some earnings in Q1, so it'll be interesting to see how those start to evolve over the next couple of quarters there. Right now, a lot of the EPS growth is kind of baked into still those direct AI names. So I think what'll be interesting over this year is to see how that evolves for those other 493 names. Because like you said, everyone and their mother is kind of looking at AI right now and figuring out how can I implement it. And there's so many low-hanging fruit
yeah.
that companies can implement, and it's only going to accelerate. Like I don't know internally. I know internally here where every group is trying to figure out AI, whether it's asset management, whether it's us folks in product, whether it's in sales, is how can we leverage these tools to be more efficient, be faster, be more accurate, and I think if we look over the next 5 to 10 to 15 years, I think the companies that are able to implement and scale that faster are going to be the winners, and the ones who don't are going to be the losers, and by extension, kind of stock winners and stock losers as well.
And that's where the managers come into play, and that's their job to sit down and figure that out, and then make sure that we're invested in those ones. Um, there's some talk in the news. Obviously we have the war in Iran and Lebanon. Very upsetting. The war is bad, but just on all levels. But we also have some news from the U.S. and they keep talking about U.S. private credit being an issue. I from what I've heard, I don't see that being, anywhere close to what we saw in 2008, 2009, or in the small bank crisis that we had a few years ago. But I guess it's just a theme where it's an area of the fixed income market that's not doing so great.
Yeah, so I was talking to our fixed income analyst actually earlier today about that.
Yeah,
It's I'm not gonna make a direct call, but from what I understand, the main issue there is the crux with a lot of these private credit funds is they could typically absorb like 5% redemptions from a liquidity perspective. When you start getting, when everyone starts heading for the gates at the same time, especially with these, private debt assets, is you got folks coming to the secondary market trying to get off private credit. What
yeah,
happens there is you start getting prices that start creeping lower and lower and lower because you've got the guy on the other side saying, well, yeah, if you want me to take on this much risk, like I'm giving you a haircut, I'm giving you a haircut. So my question to the analyst was like, what are the underlying assets? Are they non-performing? Is that the problem? And generally speaking, the underlying assets are still okay. So while there's some short-term noise here, and we're seeing some markdowns, to your point, like I don't think it's an '08 situation. Like
Okay, good.
you may get some defaults there, perhaps, but ultimately it's not 2008 in my best estimation here. And then even if we think about if we just broadly think about corporate balance sheets as well, also a lot better shape than they were in 2008 also. So in terms of big credit explosion, I don't see that right now.
No, and the US is such a different banking market than in Canada. We have such incredibly well capitalized banks, and it's well concentrated into two handfuls of banks, whereas in the US you have a lot of tiny banks that, there may be some noise about those, but every year you have some US banks going bankrupt because they just have a very strange and different regulation system than we do.
Yeah, I know that
Uh,
CFIs in the US now
yeah.
with the Basel three reforms and liquidity ratios, like they're a lot more.
Yeah, they've
Their
tightened it
balance
up
sheets are.
after that
Yeah.
whole Silicon Valley Bank issue. One last question, and then I'm gonna let you go. Put your fixed income hat back on, and if someone is looking at their mortgage right now, we're getting a lot of questions about that right now because, 6 months ago, 3 months ago, it was pretty easy for me to say, hey, if you have an option, maybe take the variable rate because rates are coming down and you're going to get cheaper rates. But now people are looking at it, and with Bank Canada even having a hike priced in, which I think is ridiculous. I don't think that's going to happen. I would lean into that personally, but um, do you think people should be going variable or fixed? And and if they are going fixed, how long should it go fixed for?
Yeah. So to think back into my swap world where
Yeah.
you'd have to think about, do I go fixed or floating on my debt? So the question you have to answer yourself is, here's my fixed rate, here's my floating rate that's offered to me.
Hmm.
Is my fixed rate going to be lower than what my potential floating rate is going to be for at least half the term?
Yeah.
So that's like what you have to think. So the first thing is like, what's your term? Is the first thing you have to think. But thinking back to the Bank of Canada, is the question I think really hinges, and here's the part that's tough, is I think the inflation story is really tied to the geopolitical unrest. So if you tell me this ends tomorrow and straight's back open, I would say float, because odds are we're not going to hike if inflation starts coming
No.
down, right?
Yeah.
The problem is that's the factor, and I have no idea when that's going to end.
Yeah.
So the thing you're going to need is, so if you go float, and I think the float. Here's the thing: is I was talking to someone about this at work the other day. I actually don't know if your 5-year fixed is above is above the float right now.
Yeah.
I think it in any case. I It's a really tough call for me to say, because if inflation
I
stays
like,
higher, I don't know that
yeah.
they'll hike
So even
necessarily.
if they were going to cut, like how much would they cut, right? And that's kind of where I see maybe another half a percentage point, right? And
Yeah,
then I say to myself, well, I'm getting offered something starts with a three, right? I know I can afford that payment.
yeah,
If I lock it in for 3 years or five, let's say 3 years, I know what I'm paying for the next 3 years, and I have certainty, and I don't need to stress about it. And in 3 years, we'll worry about it then, right? And that's kind of where my brain goes on it right now.
I,
You could go variable and hope that you get another half a percentage point, but the variable trade was 2 3 years ago when people were getting 5% mortgages and taking variable and riding that down, and that worked out really well for a lot of people.
yeah. I mean, generally, when it comes to a mortgage, I'm also
Yeah.
kind of with you there. I'm like, can you afford that 5-year fix?
Yeah.
Does it does that work for you in your budget?
Mhm.
Because like, to know, like, here's my line item for the next 5 years of my spreadsheet of what my mortgage is going to cost me, and I don't have to worry about what the market's doing every month, and it makes sense for you. Like,
Yeah.
personally, I'm like, take the fixed rate if it works in your budget now. Like, just lock it, especially if there isn't a massive spread between float and fixed.
No.
I'm personally of that mindset. Right now, like I honestly don't know. There's so much uncertainty right now. Like I could see a scenario where we hike rates by the end of the year. I could see a scenario where we cut rates into the year. Like it's just I honestly don't know.
No, it all depends. It all depends on what happens over in the Middle East, unfortunately. So,
Who knows? Who
I
knows?
know.
We get tweets every other day pointing in one direction and then the next. So it's your
Okay.
guess is as good as mine.
Well, listen, Andre, I wanted to thank you for joining us. We've almost used up all the time that you promised us, so give you back a little bit of time. I want to thank everybody for joining us on this call. Or if you're listening to this, the recorded version, then hopefully the weather is better than it is today. And hopefully everybody has an amazing Monday. And thank you also to Claudine for setting us up. And thank you, Leah, for keeping us organized. So it's really great.
Thank you.
And everybody have a wonderful day. Thank you so much.